What's up, everyone? My name is Jabari Elliott, and welcome to another episode of Financial Finesse. In today's video, we're going to compare two of my favorite stock-related investment tools, ETFs and mutual funds. ETFs are really my favorite, but mutual funds provide a lot of opportunity for investors who are risk-averse like myself. And with that, let's get started. ETFs and mutual funds are just two of many investment vehicles linked to the stock market. And after adequate research, both can be uniquely appropriate for beginning investors. An ETF, or an exchange-traded fund, is an investment fund that involves a collection of securities, such as stock. ETFs can also contain bonds, currencies, and commodities. ETFs are very similar to mutual funds, as they also involve a basket of securities. Both ETFs and mutual funds were created from a concept called pooled fund investing. Pooled funds are funds in a portfolio from many individual investors. The funds from these many individual investors are pooled for the purpose of joint investment. Investors in pooled funds benefit from a concept called economies of scale, which enable lower trading costs. Importantly, ETFs nor mutual funds are direct security investments. Technically, they are conduits of investing and connect the investor to the actual investment. And ETFs and mutual funds offer diversification through their basket of securities. Unfortunately, investors do not have a choice about which stocks make up the portfolio for an ETF or a mutual fund. And now, let's discuss the differences between ETFs and mutual funds. While ETFs have a fixed basket of securities, mutual fund securities are constantly bought, sold, or held. Simply put, mutual funds are actively managed while ETFs are not. Instead, ETFs hold a fixed basket of securities that can reflect an industry, sector, or index. Now, an index is a method of measuring the value of a specific segment within the entire stock market. Indexes serve as tools to compare the performance of a particular stock against an accepted standard. Examples of indexes include the Dow Jones Industrial Average and the S&P 500. And the ETF DIA tries to reflect the Dow Jones, meaning DIA will attempt to hold a securities portfolio that mirrors the composition of the Dow Jones Index. As noted, an ETF can also mirror industries and sectors. For example, the Invesco Solar ETF TAN tracks an index of global solar companies and includes companies based on the revenue generated from solar-related business. Another key difference between ETFs and mutual funds is how they are bought and sold. ETFs can be bought and sold like stocks in share amounts of 1, 10, 100, or more. Mutual funds are usually bought in currency amounts, such as $100, $500, or $5,000. Additionally, various order types can be placed on ETFs, and they are optionable, meaning you can buy or sell options on them. If you are unsure about an ETF investment, you can put certain strategies in place to protect you from loss, such as stop loss orders and trailing stops. If you need a refresher on trading options or different stock order types, feel free to watch my videos on either subject located on my homepage. ETFs are also marginable, meaning you can borrow against them if you have a margin account. Mutual funds usually aren't marginable, but check with your broker to see if any exceptions might apply. Ultimately, investors who want more assistance or are less risk averse may elect to go with a mutual fund. Now, because they are actively managed, mutual funds can include fees that may eat into gains. For those more comfortable with making their own investment decision in terms of the industry or sector they want to invest in, an ETF may be a better option. However, your wealth goals should always match your investment strategy. That brings us to the end of the comparison between ETFs and mutual funds. Please like, comment, subscribe, and be on the lookout for future videos. And as always, keep finessing.